What advice would you give to investors who need to preserve their capital and their purchasing power in an inflationary environment?
The best thing is to have a lot of earning power of your own. If you're the best brain surgeon in town or even the best lawyer in town, you will retain purchasing power in terms of your income no matter what happens, whether people are using seashells for money or whatever as time goes by. But in the investment world, it's tougher. But Charlie and I think the best answer is to own fine businesses that will be able to price in inflationary terms and will not have huge capital investment that is required to handle the larger dollar volume of sales. Some years ago, I used See's Candy in the annual report as an example of the kind of business that more or less can handle an inflationary world and maintain investment and value no matter what happens to the currency. Unfortunately, most businesses will not come out well in real terms during inflation. Their earnings may go up a fair amount over time, but they're compelled to put more and more dollars into the business just to stay in the same place. And the worst kind of a business is one that makes you put more money on the table all the time and doesn't give you greater earnings. So you really want a business that can have pricing that reflects inflation and does not have very much capital investment that reflects inflation. But inflation is the enemy of the investor in terms of real returns. As you know, there are, in this country as well as a half a dozen other countries, there are what they call inflation-protected bonds. We call them TIPS in the United States, where the income is adjusted, or the principal amount is adjusted to inflation. And that's not a bad investment for people that have worries about inflation heating up. And I think, incidentally, we're starting to see it heat up in this country. Charlie?
Yeah, most people are going to get a very small real return from investment after considering inflation and taxes. I think that's an iron law of the world. And if for a brief period some of us do better than that, we ought to be very thankful. One of the great defenses to being worried about inflation is not having a lot of silly needs in your life. In other words, if you haven't created a lot of artificial demand to drown in consumer goods, why, you have a considerable defense against the vicissitudes of life.
Charlie, we're selling consumer goods in the other room. It's okay to talk that way at home, but
doesn't do any good there.
I know the feeling.
This question comes from Mark Jordan in Charleston, South Carolina. He writes, in a period of high inflation, which particular businesses owned by Berkshire Hathaway will perform the best, and which will perform the worst, and why?
Well, the businesses that will perform the best are the ones that require little capital investment to facilitate inflationary growth and that have strong positions that allow them to increase prices with inflation. And we have a candy business, for example, and the value of the dollar since we bought that candy business has probably fallen at least 85%, I would say, 80 to 85%. And that candy business sells 75% more pounds of candy than it did when we bought it, but it has 10 times the revenues, and it doesn't take a lot more capital. So that kind of a business, any business that has enough freedom to price to offset inflation and doesn't require commensurate investment or huge investment to support it, will do well. Businesses like our utilities, which get, in effect, a bond-like return, but require, if you're going to build a generating plant, it costs twice as much per kilowatt hour of capacity, and all you're going to get is a fixed return. and yields on bonds go up, perhaps dramatically if you get high inflation, is not going to do that well in an inflationary period, just because it has certain aspects of a bond-like investment, and bonds generally are not going to do well in inflation. Charlie?
Well, but like our insurance operations, our capital-intensive railroad business is certainly one of the best railroads in the world, and our utility operations are certainly one of the best utility operations in the world. And so it isn't all bad to be up there world class in your main businesses.
Our railroad, the government's talked about building a high-speed rail system in California. I think they're talking about 800 miles of track. And their estimated cost was about $43 billion. And estimated costs on constructions of things like that go up dramatically, much more often than they get reduced even by a minor amount. And of course, we paid $43 billion, counting debt assumed, for a rail system which has 22,000 miles of main track and 6,000 plus locomotives and 13,000 bridges if you ever want to buy a bridge. So that the replacement value of that asset during inflationary already is huge, and it would grow dramatically, and the world, our country, will always need rail transportation. So it is a terrific asset to own. I'll just leave it at that.
There's no question that the lack of inflation is a plus for owners. I mean, the real return you will obtain, in my view, from owning American business, if purchased at similar prices, the real return will be higher if we have long periods of low or close to no inflation than if we had long periods of high inflation. I don't think there's any question about that, because that article went on to explain how you got taxed on nominal returns and fictitious returns in real terms. So your question is about which period is better for investors. A low inflation period over any long period is better for investors. And the problem, as you pointed out also, was the starting point in terms of predicting modest returns for equity investors. The returns weren't necessarily so modest, I predicted. They were just modest compared to what people had begun to think returns would be during that long bull market from 1982 to 1999. There were polls taken by Gallup, working with, I think, Payne Weber at the time. Now they've moved it over to UBS Warburg, that showed the expectancy of people in the stock market, and those returns that people expected got up to 14 or 15%, as I remember. And they were thinking they were going to get 14 or 15% in a low inflation environment. Well, that was dreaming. And there's nothing wrong in a low inflation environment at all in earning 6 or 7%. That's probably as well it is as good as will happen, because in a low inflation environment, how much is GDP going to grow? Well, GDP, if you have a 2% inflation and even 3% real growth, you're talking about 5% in nominal terms GDP growing. If GDP grows at that rate, over time corporate profits will grow more or less at that rate. And if corporate profits grow at 5% a year, the value of those corporate profits, the capitalized value, will probably grow at something like that over any long term with a sort of a normal starting point. And add that to dividends, and you will get 6 or 7% before frictional costs. Investors incur a lot of frictional costs. They don't have to, but they do, and that often is 1.5%, 2% of their investment. So the math isn't bad. It's just bad for those people that got used to or expected very high returns based on looking in the rearview mirror back in 1998 or 1999. Charlie?
My general attitude is just slightly more negative than Warren's.
You've heard it, folks. That isn't the end of the world. I mean, in effect, if the people who own American business get 5 to 6% of the pie, $10 trillion economy now, someday a $20 trillion economy. But if we get 5 or 6% of the pie, those of us who put our capital out to produce goods and services for American business, for American consumers, American population, is that I don't know whether that's, is exactly what somebody who designed the universe would come up with, but it doesn't strike me as crazy in either direction. I think that that's a lot of goods and services to go to people that put up the capital, and you've got 100 million plus people in the working force that are working to turn that out for you using your capital, and it provides what I would regard as a pretty decent real return if you have low inflation. If you get into high inflation, as I wrote about back in '77, you could easily have the real return to investors get to a very, very low number, and perhaps negative. I mean, inflation can swindle the equity investor, as I wrote back then, and I used 7,000 words to explain why. I will be glad to send you a copy of that article if anyone's still interested. But inflation is the one thing that over a long period of time can turn investors' results in aggregate into a negative figure. And it's the investor's enemy. Charlie, does that bring forth any further thoughts?
I don't think you'll get perfect help on these subjects from the economics profession either. They have certain standard formulas. To an economist, when a manufacturing job goes to China, that's just so much productivity increase. And if you ask one, well, suppose all of the manufacturing jobs in America went to China, wouldn't that be a little too much efficiency increase? And their answer would be no. And people actually get paid for thinking like this in major universities.
What would get across the point, of course, is if all the teaching of economics got exported to China, in which that point a new insight would appear. Number 6.
Jack Hurst.
But given the fact that we're dealing with fairly high levels of inflation in India, what would your advice be to people who are investing? What should they change? What should they do?
Yeah, well, inflation, Keynes said it many years ago that it's an invisible tax that only one man in a million really understands, and it's a tax on people that have had faith in their currency that the government's issued. The best protection, the best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents, and if you increase your talents, they can't tax it while you're doing it. They can't take it away from you. So if you become more useful in your activities, your profession, doctor, lawyer, whatever it may be, that is the best protection against a currency that might decline at a rapid rate. And the best investment, passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency. But it's interesting. In the United States, the value of the dollar since I was born has declined by 94% to 6 cents. So inflation is a very cruel tax on people who believe in fixed dollars, but things can work out pretty well even during inflationary times. I mean, if somebody told me when I was born, that the dollar bill is going to go to 6 cents, I might have said, let me go back. I'm not interested in emerging into that kind of a world. But actually, it's worked out pretty well, so I have no complaints.